Hello, everyone. Today we learn how to design trading as rules, not luck. Discretionary trading? It's as uncertain as guessing when your morning coffee jumps from Tila 3 to Rolo 4.50. But a rule validated on past data? That's different. We drop vague feelings on the chart and trade clear signals. For example, only buy above the moving average. Today's 3 pillars. First, make the rules explicit. Second, test whether those rules really worked in the past. Third, bake in real trading costs. A year from now, you'll wonder why you ever traded without a system. Looking at 디스스파이 유클리 차트 더 S&P 500 ETF 에브리 트레이딩 시스템 고지수로 이그젝트리 3 stages. Stage 1 is the idea. Follow the trend, but only when volatility is low. That's a concept, not something a computer can run. Stage 2 is rules. Trend. The 10-day average is above the 50-day average. Trend strength. ADX at 20 or higher. Now you can give the machine orders. Stage 3 is validation. You backtest 5 years of data and get a Sharpe of 1.8. Is that a real edge or just luck? Clear rules mean someone else can follow them, and you can diagnose why failure happened. Gut feel trading can't do either. Look at this Bitcoin daily chart. Markets flip between 2 states, trending, a clear direction, and ranging up and down with no progress. The same signal behaves differently in trends versus ranges. Statistically, signal reliability is known to be much higher in trending regimes. So we auto-classify market mode with 4 tools: ADX, trend strength, Bollinger Bands, volatility width, ATR, range size, and MA separation, distance between short and long moving averages. For example, ADX above 25 means a strong trend. Take a full position. ADX at 15 or below means a range. Sit out or switch to a mean reversion playbook. Add this filter and false signals in choppy ranges drop. Why? Because you ignore low confidence signals in the first place. On this SPY daily chart, some months swing hard and some months are quiet. When volatility is high, you ease off the gas. When it's low, you speed up. The math is simple. If your target volatility is 3%, A months and realized for is 4%, 포지션 사이즈 3% 나누기 사인 4% 0.75 곱하기 사인 only take 3/4 of full size. Say your starting capital is $50,000. In A 4% per month, you deploy only $37,500 and $12,500 in cash. Why bother? A big position in a high-vol month can shake your whole stack on one crash. Like putting every dollar you need for rent into a high-risk bet the same month bills are due. Resize once a month by volatility, and your portfolio quietly runs in risk control mode. When you evaluate a strategy on a Bitcoin weekly chart, the industry standard uses 3 metrics. First, Sharpe ratio, excess return per unit of risk. Roughly 1.5 plus is often called solid, 2.0 plus excellent, as a tendency, not a guarantee. Second, Sortino ratio. Unlike Sharpe, it only penalizes downside. Upside volatility is profit. Practitioners often aim for 2.0 or higher. Third, Calmar ratio, annual return divided by maximum drawdown, MDD, the worst peak-to-trough loss. Fund managers watch this a lot. Again, 2.0 plus is commonly read as strong. How the 3 line up reveals the strategy's character. If Sortino is much larger than Sharpe, downside was small and upside was large, trend following likely worked well. But be careful. A Sharpe of 2.0 that ignores trading costs can fall to around 1.2 once costs are subtracted. Performance without costs is a picture on paper, not a live edge. When you test a strategy on SPY daily data, 3 traps wait. First, survivorship bias, testing only the winners that still exist. Backtesting only today's top 50 names as of 2025 is wrong. Historical data must include every name that was listed at the time, including the ones that later delisted. Second, look-ahead bias. Using March 31st earnings in a March 1st signal? Absolutely forbidden. At each signal time, use only information you could actually have known then. Third, overfitting bias. Tuning parameters until the past looks perfect. Test 36,000 parameter combos and keep only the best. That's a custom suit fitted to history. Odds are high it won't fit the future. The fix is walk-forward analysis. 트레인 파이브 이어즈 그러면 갤러데이돈 이어 그러면 롤포워드 인두 리피트. Trust only out-of-sample results. Performance on data the model never trained on. In-sample Sharpe of 2.0 and out-of-sample of 0.8, that strategy is a mirage of the past. Risk is high it won't work going forward. To trade the Bitcoin chart on screen for Real, you must count costs. For liquid U.S. stocks, round-trip cost is often near zero commission at many brokers plus spread and slippage, roughly about 0.05 to 0.15%. Crypto spot venues commonly run around 0.10 to 0.2 round trip, depending on fees. 20 라운드 트립 세이 먼스에 대해서 0.10% 이치 코스트 어바웃 2.4% AE이요. 50 A 먼스 캐닛 roughly 6%. The higher your trade frequency, the more costs dominate. That's the lesson. Always include costs in the backtest. In Python vector BT, it's one line. Fees equals 0.001. And in TradingView Pine, you just add a commission underscore value option. Final tip. Before real money, paper trade for at least 3 months. Record every signal with no cash at risk. Psychological bias, fear, greed often moves the needle more than the numbers. System design, regime filters, volatility targeting, performance metrics, and the cost model. These 5 give you the eye to tell a validated system from a rule that only fits the past. This lesson is for education only and is not investment advice. All trading can result in loss. Judgment and responsibility are entirely your own.